Good morning, traders. This is our market analyses and performance review for the week of Monday, February the 27th. Okay, without further ado, let's jump right into it. I am so thrilled with our trading performance results from last week. Last week was a tough week. It was a very trying week. We got into a neutral rating in our technicals that we follow, and those of you that follow me know I hate the neutral rating periods because they are incredibly hard to predict. Support resistance levels don't mean as much as they normally do, and it's just a tough market environment, and we absolutely crushed it last week. We'll get into obviously our performance results from last week in just a bit here, but let's go ahead and take a look at the market for this coming week and see what we find. So we do look at a sort of technical matrix of about 12 different indicators, along with simple and exponential moving averages. We factor in the pivot points. That helps us get a starting place for where we find our support resistance areas to work in. And we look at these metrics on a daily basis inside of our live trading room. However, for this analysis, we pull back a little bit. We get a little bit bigger 30,000 foot view, if you will, and we take a look at the weekly results. And wouldn't you know it, once again, we've been working on a neutral rating on a daily basis for a couple of days. And now we are at a neutral rating on the weekly basis. You'll see this reflected in the charts here in just a moment. We're kind of in no man's land. We're not really overextended to the upside. We're not overextended to the downside. We're sort of back to this neutral zone that we have sort of been bouncing around in for quite a while. This goes back almost to November of last year, this new range that we are in. But again, I do not like the neutral ratings. I think that the market abhors a vacuum. The market doesn't necessarily care if it's going up or down, but it does like a directional bias. And as traders, that's imperative for us. Again, we don't care either if the market's going up or down, but we want to be able to see that imbalance every day of more buyers than sellers, more sellers than buyers. It gives us confidence in our trend following. And right now, it's just a little bit tough because we're sort of in this neutral zone. We look at the key support resistance areas in the overall market. We use the E-minis to give us some continuity here in our charts. And there's a couple of things that I note here right off the bat. So you've got February 2nd here. That's the high that we've been coming down. So basically this entire month of February has been one big slide back. You see the January start of what was a nice little bull run, and now we're trying to give a lot of that back. We've given about half of it. We've given about half of it back this month. And so again, January very bullish. February's been very bearish. We are sitting, again, it's no surprise really that we're getting these neutral indicators in the marketplace. We're sitting right on this red line right here. This is the point of control. You can see the open interest volume right there. We're sitting right on the key level here of point of control, that 4,000 area on the E-minis. It is a critical area. VWAP, volume weighted average, the VWAP is just down below where we're at right now. It's about 30, this is about 39.90 right here. Of course, VWAP comes into play, or may come into play here a little bit as well. We use VWAP quite a bit on a smaller scale in our scalping room. This 38.40 cliff, I call this the cliff. We're heading back down to that area again. So I think there's two really big demarcation points on the charts right now as I look at it. Number one, again, is right where we're at right now, which happens to be point of control, this 4,000 level. It is a critical level for the marketplace. And then what I call the cliff down here at 38.40, that's really been the bastion of support for this marketplace going back to December of last year. And I think if we could break that, we really could get some momentum to the downside. And obviously, we're getting a little bit closer here after this big run in January. But again, we're back to a neutral rating, back to the center of the range. You can see that we're back here in this range this range was established back here in around November 10th. Right there, you see that sort of starting point. That range that we're in right now goes back to November 10th of last year. So again, a whole lot of movement from the end of last year until today, but we're basically right back to where we started. So it'll be interesting to see. You know, we talk about this a lot in our live trading room. There's only really two markets. Again, as traders, we don't care if the market's going up or down, but we do like that directional bias. And there's only really two markets that we do focus on. That's consolidating markets and expanding markets. We have been in a consolidation mode for a while here. We're back into this range. We want to see if we can get some expansion now going forward. Is it going to be to try to break back out to new highs, get back above this February 2nd level that we hit? Or are we going to move back down to the cliff area to where we really have some, I think, substantive potential for downside moves? So we'll have to see. Again, we're sitting at a neutral rating right now. If we pull in a little closer here on the charts, we can take a look at a 2-hour chart. Now, this is what we trade off of every day in our live trading room, is a 2-hour candle chart. It gives us our starting point for the day. It gives us a little bit of directional bias. It gives us an idea of support resistance areas. I'm going to give you my numbers here for today as we start off the week. On the resistance side, I'm looking at that 4,000 level. Of course, that's a huge level. Above that is 4,015. Above that is 4,021. Then 4,034. And then 40.50. So on the upside, on the resistance side, these are the levels that we're working with today. On the support side, going down, it would be, again, 39.81, just down below that 4,000 level. Again, that 4,000 level is just absolutely critical. But on the downside, 39.81, 39.68, 39.48, and then 39.28. So those would be my levels on the downside. As we go forward today, again, it's going to be an interesting day. We're about 2.5 hours right now out from the Monday, February the 27th market open, cash market open. Right now, it looks like we are going to be starting on the put side with our 0DTE trade. Futures are up about 21 points right now, and they're pushing. They're pushing on that 4,000 level once again. We continue on and we look at some of the support and resistance levels from all of the major indices. We have specific and, I will say, unique, different trading strategies that we trade in our live trading room every single week on all 4 of these major indices: the SPYs, the Qs, the IWMs, and the DIAs. They are different strategies. We diversify amongst the different indices with different strategies. I think it gives us the best blend of risk versus reward. But you can see, I think, probably the main thing that I think is important to look at when we look at all of these major indices is where they're at in relationship to the 200-day moving average, this red line right here being the 200-day moving average on each one of these. You can see that number one, all of them are above the 200-day moving average, but they are getting closer and closer to those levels. 200-day moving average, huge demarcation point in the marketplace. There's all kinds of lines in the sand that you can draw as a technician in the marketplace, but nothing that is probably as substantiated over time and validated over time as the 200-day moving average. It is a big line in the sand. It's very tough for the market to break below it or break above it, but once it does, if it can, it's usually the shackles are released and it's off to the races. So it will be interesting to see if we can continue any of this bearishness that we've been having for this entire month of February, get down to that 200-day moving average. What does the market do with it? Does it act as the support level that it generally does? And do we get a bounce off of that? Or do we drop below that? If we lose the 200-day moving average here, I would say that there's probably a good chance to say, hey, look out below. So we'll see how that develops here over the next little bit. Year-to-date performance, I was watching a documentary on some professional traders that are renowned traders that are sort of mythical in nature because they've had these amazing track records on Wall Street. And it was interesting that 3 of the top 10 that they went through and analyzed used basically reversion to the mean trading strategies, just simply meaning that what goes up must come down, what goes down must come up. And maybe using things like Keltner channels or Bollinger Bands to help them identify overbought or oversold areas. But it was basically just a simple reversion to the mean strategy, which we use quite a bit here in our live trading room. And boy, you can see that playing out this year so far. The Qs, we said, look, up 18% in 1 month. Yeah, that's probably not sustainable. Probably not going to see the NASDAQ up 200% at the end of this year. Same thing with the SPY. We're now coming back down to earth with about 2 months into the year. We're up about 4%. By the way, we're going to get into this in just a second. Our investing asset allocation model, the ATM program, the asymmetric trading system, we've almost doubled this. We're almost double what the market has done. Not quite double, but man, it's impressive. We'll get into results in just a second. But the market's up about 4% looking at the S&P. And again, I think you can denote here how important it is to, I think understand the importance and the validity of trading indices versus maybe individual underlying stocks. But sometimes we lose the value of trading all of the major indices. And you can see right here, it absolutely makes sense to do so because there is dramatically different performance in all of these over the short term. Over the long term, they tend to sort of meld together, but in the short term, you definitely can get some big divergences there. We look at the sector rotation over the last week, and it's not very telling for me. Pretty much everything was down over the last week as we had another bearish week. Energy is starting to grab some bids here, which is, I think, a little surprising. I think I was a little bit more bearish on our energy setups than I probably should have been, as energy does seem to start finding some bids here. We'll see how that plays out over the next week. But it is consumer discretionary that has really been hit the hardest. That is the area also that we are starting to look at getting some long positions in through selling cash secured puts. So a couple of things just to note here. Again, I'm not pulling any one sector out this week. Usually I find one sector that is just glaringly overbought or oversold, and we can trade that reversion to the mean approach. Not so much this week. The other thing is pretty much everything's just getting hit across the board right now in this marketplace. We look at the heat map. And unfortunately, I was sick last week, so I didn't put out a weekly preview video. So I don't have the previous heat map to compare to, but you can see again, mostly red across the board. Basic materials had some strength, and there was some strength in the banking sector and insurance sector as well last week. But pretty much across the board, weakness. We continue on, and in terms of what we're looking for this past week, as I said, across the board weakness. NASDAQ was the one that really got hit the hardest, and the DIAs surprisingly hit as well. We have a very specific ladder strategy that we trade on the DIAs, and that was a little bit surprising as well, how much weakness it showed during the week, but it was obviously an ugly week for all of the indices across the board. One of the indicators that we look at, that we try to use to help us position ourselves in our overall portfolio delta, we have what we call a model portfolio inside of our live trading room, and that's either going to be sort of a negative delta or a positive delta overall stance. We use the put-call ratio to help us with that. And again, nothing has really changed over the last couple of weeks. The put-call ratio is below 1 on all of the major indices that we look at. That's still bearish. It's still flashing us bearish signals. It's not a huge signal. It's not tremendously down. We're not down here in this range. But it is below 1. That means it's a bearish indicator. That's something that we look at. Expected moves, I think it's going to be interesting this week. Very light news week this week. We don't have a lot of planned catalysts this week. You may say that we're not much different than last week, but again, remember last week was a holiday shortened week. So a 76-point expected move in the S&P this week, probably a good chance we could break through that, and that's a challenge for credit sellers. That means that most of the options that we're going to be selling could be, in best case scenario, fairly valued, worst case scenario, undervalued. You want to be selling overvalued options, buying undervalued options. So could be a little bit of a challenge for us this week. That's not the kind of movement we want. We spent a lot of last year with 140-point expected moves on some weeks, and the premium was amazing. But we work with what we have right now. So we'll have to see come next week how accurate this is, how accurate the market makers were at pricing in the expected move for this week. Because for me, I feel like that might be a little low. We'll have to see how that pans out. We look at the fear and greed sentiment reading. That also helps us give us an idea of sort of where everybody is at in the marketplace. It is a contrarian indicator. When everybody's greedy, you should be fearful. When everybody is fearful, you should be greedy. And we're moving again sort of back into that neutral zone. So no huge implication here for me with this indicator, with the fear greed indicator. I think, when you get into the extreme greed or extreme fear areas, those are the areas that you want to press and you really want to put your capital to work. So again, this is, I think, just reflective of all of the other things that we're looking at for this week, which is we're pretty darn close to neutral on everything. We look at the open interest levels. This is important for us. Some people call them, help us define where the point of control is. Open interest levels, gamma walls, support resistance areas. There's a lot of data that you can pull out of this, but basically this is just where all of the volume is. This is just where all of the activity is, and this is on the S&P. And again, surprise, surprise, that 4,000 level, this is Custer's last stand right here. This is the big demarcation point. We get down here to this 3940 level, which I've talked about again is the cliff. That's a big area of focus as well. And then you've got some pretty big resistance, I think, up here at 4060 also, and then 4100. So we'll have to see how this plays out. But obviously right now, yeah, you can see we are sitting right on this big demarcation point. And again, there's only two markets. There's consolidating markets and expanding markets. We're not going to sit here forever. Eventually, we're going to move. And I think the move could be substantive once we get off of some of these open interest levels. We look at the volume in the S&P, and volume has been pretty constant right here. No big spikes and no big drops. So that's fairly healthy for us. To be honest, we would like to see a little bit more volume, a little bit more activity, but it's been pretty much the same for quite a while now. We look at key news items for the week. Again, fairly light week this week. We've got durable goods out on Monday. We've got Canada's GDP on Tuesday. Our oil inventory numbers come out on Wednesday. We have an oil trade that we work on every single week, oil strategy in our trading room that's been incredibly successful for us. So these numbers are very important for us. Jobless claims on Thursday. That could be a market driver. You never know with jobless claims, but lately it's been able to move the markets for us. That's important because Thursday we will be in our live scalping room in our trading program, and so that could hopefully give us something to work off of. Nat gas numbers come out on Thursday. We're looking at adding a nat gas trade back into our model portfolio this week, so that'll be something to take a look at. And then Friday, quite a few Fed speakers coming out. You never know what they're going to say. That might be a market move as well, but fairly light news week for this week's trading. Our updated performance results for last week and year to date. Let's take a look at where we're at. We start off with, of course, our 0 DTE. This isn't our flagship trade, but it is our most popular trade, and it is a trade that we do every single day. And I guess the big standouts that I would note on our 0 DTE performance for this year, number one, the NDX, the NASDAQ. Oh my goodness, the NASDAQ is so much harder to trade than the S&P. It is a much, much more difficult animal to tame than the S&P, but it has been our standout this year. The NASDAQ has brought 80% of our profit in this year on our 0 DTE trades. We've had 39 days of trading opportunities. We've done 55 total trades. That is incredible. Generally speaking, we're going to get 1 0 DTE a day. We're one and done. That's how it works. Every once in a while, we can double dip and get a second one in there. But this year, the NASDAQ has had premium that has been so overvalued and held in there so long into the day that we've been able to put an extra one on quite frequently. So that's why we get 39 days of trading opportunities, but 55 total trades. We've had 53 winners, 2 losers, 97% win rate. We are very, very proud of our 0 DTE results. If you're trading 0 DTEs and you don't really have the potential to make a good chunk of change every day, if you're not able to put serious money into your pocket every single day with a 0 DTE, maybe you're trading butterflies or something like that, that's just a guess and a gamble, you might want to take a look at what we're doing here. I don't know that you're going to get a better win rate on 0 DTEs, and you're certainly not going to get a better dollar potential. Keyword potential. You never know what the results are going to be, but it certainly is better than trading butterflies or something that you're seeing out there right now. A lot of that taking place. Our 4-day to expiration SPY and Q trades, 20 wins, 1 loss so far this year. We've been very, very challenged on a lot of our 4 DTE trades this week, or excuse me, this year. But yet we've been able to manage them. A lot of rolls in there that we've had to work those trades over and over. But so far so good in that area. Our IWM 4-day to expiration strangles. We call this the millionaire maker. This is the trade that we're going on now 2 years with no losses in that. I am very, very excited about the IWM. We're moving from more of a static approach to this trade to a dynamic approach. And I think it really will give us the potential to increase our return performance on the millionaire maker by maybe as much as 10 to 30% a year, which would be absolutely huge. But so far this year, we've had 8 trading opportunities. We've put 12 total trades together. Every one of them, once again, has been a winner. So we continue a multi-year winning streak of not having any losers on the IWM. Our pairs trades, we did just go through a whole new batch of pairs trades, added 3 new pairs trades. 7 of them have been closed out as winners. We do have 2 that are still working. But I would anticipate that we'll be able to move those into the winner circle as well. Pairs trades are awesome because you can trade them with $200. If you're what we like to call capital constrained, pairs trades are an easy way to get started as a trader. Our bear market trades, we've had 5 total trades with 5 winners, no losers there. That's been a great setup for us. We don't find a lot of those setups. It's not a trade that we're going to do 50 of them in a year, but when we find them, they tend to work really, really well for us. Our equity 4-day to expiration strangles. So we've brought PayPal back into the mix now. We used PayPal all of last year, 2021. And it was an absolutely fantastic trade for us. We absolutely killed it on that. That was another trade that we traded all year long without any losers. And so far, so good this year. We're trading 2 of the equity underlyings for these strangle setups. We're using Netflix right now, and we're using PayPal. We did have to do a pretty aggressive adjustment last week on Netflix as news came out that they were lowering their subscription fees in 30 different countries. But so far, so good in that category. It is one of the most flexible trades that we have in our setups. That means that they're fairly easy to adjust. That's really why on these types of trades, these strangles, we have all winners and no losers. It's not because we're amazing traders. It's just because that's a particular setup that's fairly easy to manipulate and adjust if needs be. Our positive Vega DIA ladders, we've put 8 of those together. This is a trade that we will sometimes trade every single week as an adjustment, but it is just basically set up for in every other week adding a new ladder to these trades. It's been a great trade. Each one of these ladders that we put in has approximately the potential of about 9% return in a month. That's what we shoot for. And so far, so good on that setup. It's been an absolutely good moneymaker for us consistently in the trading room. Scalping last week, obviously we took Tuesday off because of the shortened holiday week. So we were in our live trading room Zoom feed on Tuesday. Thursday was an amazing day for scalping for us. If you use the ES, so we brought in about $1,780 of profit if you were using the ES. I already had a long ES position on, so I was using the MES, which basically meant I made $178. But either way, it was a good day for us in the scalping room. Dragonflies, again, lots of news-driven items here on scalping. I will say, if you're interested in scalping and want to look for a way to, not necessarily if you're interested in scalping, if you're interested in finding a way that you really have a viable chance of making $500 to $1,000 a day, scalping might be something that you want to take a look at. Again, there's no guarantees, but that opportunity does exist in scalping. And you've seen as we report our performance results that it is realistic to be able to make $500 to $1,000 a day in scalping. Again, no guarantees, but that opportunity is there. Our dragonflies, double diagonals and zebras, we had another dragonfly and in a profit with BA. We're going to be looking at adding that back into the mix this week. It's been a good trade for us. As of recently, we had a BA trade last year that was a tough one for us, but so far so good on our dragonflies. Theta Fairy, we are up to 37 total trades this year, 36 winners, 1 loser. If you are not interested in getting an extra $100 a day dropped into your bank account or slipped under your pillow, as the case may be, I don't know what else to tell you. It has been an absolutely awesome trade for all of our members. And I think that it's a very realistic goal to say, yeah, that one trade right there could potentially add $20,000 a year to what you're doing. We're bringing in, on average, about $1,600 a month. in income off of the Theta Ferry. It's been an absolutely fantastic trade. Our gold ladder, 9 total trades so far this year, 9 have all been winners. We're able to bring in a credit and work these trades over and over again, but we do need to get these trades to expiration. We are a little bit below our targeted goal on these ladders. We're trying to make 1.5% a week on the gold ladders. That's obviously about 6% a month, about 70% a year. We're behind the curve on that. We're a little lower than we want to be on the ROI. They're all working for us, but we just need to get some of them to expiration to maximize the return on those. Our overnight vampire trade, we're up to 2 of these now, and we're batting 50%. The first one that we did was a winner. The second one was also a winner for a good portion of the trade, but myself and probably most of our members in our trading room were a little bit greedy. We didn't take the profit when it presented itself, and it ended up being a loser when everything was said and done. So lesson learned, I guess, there. We talk a lot about in our trading room, don't let a green trade turn to a red trade. We certainly broke that rule here on our last overnight vampire trade. Oil ladders have been great for us this year as well. Of all of the ladder strategies that we employ, oil has the highest ROI potential. It's through the roof. We use the futures contracts on oil, and so far so good on that one. That one's been fantastic. In the money cover trade, obviously we have some trades that are huge in popularity in our trading room. The Millionaire Maker, IWM trade, the Theta Ferry is very popular. Scalping, obviously, the ability to bring in $500 to $1,000 a day is very popular. The oil ladder, the ROI on it is exciting. But this trade right here, the in the money cover trade, probably one of the better trades out there. And I should have up for you tonight the training video on that. So look for that later tonight. Awesome, awesome trade. And it's been a great one for us. We haven't been able to take all of these 4 trades to fruition. We've only got one of them, 2 of them that actually went to fruition, but all of them have made money. Very good trade for us. Broken Wing Butterfly Ladder, so far 3 trades in there, 3 winners. This is a fairly new trade in our trading room. We're going to start working on expanding this out, putting some more capital in it. Just getting started with the Broken Wing Butterfly Ladder strategy. We set up a short portfolio. This is a separate portfolio that is a small account. We actually built this in my teenage son's account using his money. Got about $1,900 of buying power committed there. It's all spread across different short positions, equity positions, and we're up about 9.7% on that so far. So far so good on that. It's been a great portfolio for my son. XSP Fly portfolio. This is an interesting setup as well. We're putting very, very low cost butterflies out there on our trade, 2 to 3 at a time. No more than $10 into each one of these, and that $10 has to come from profits from our 0DTE. So we never put a single solitary penny of our own money in these flies. We only put profits. Never put principal, only put profits in there. We put about $50 into those so far. Only one of them has worked, so we put 5 on. Only one has worked, and we're still at a $65 profit on the trade. They're so asymmetric in nature. You put about $10 into the trade. If it hits perfectly, it can make about $400 in profit. So I would anticipate that we'll probably have 90% of these trades fail on us, and that yet we will still have a pretty darn good chance of finishing in the profit zone. It's been a fun trade for us. Last but certainly not least is our heralded, should be award-winning investment program, the ATM program. This is the asymmetric trading method. It is a passive investing asset allocation model. It has absolutely been fantastic. If you have investment funds, not talking trading funds, we're talking investment funds, I don't know where you're going to go and get these kinds of results. We crushed the market in 2021. We crushed it in 2022. And we are crushing it right now in 2023. In spite of the fact that the market has been amazing this year, the market's on track for a 50 to 60% annualized rate of return. Yeah, we're beating it. So it's just been absolutely fantastic. If you want to come trade with us and check us out and ask questions and interact with our trading room and our trading members and get their 2 cents, get their opinion on whether or not they feel like this is the very best trading room online today, we'd love to have you. You can go to try0dteforfree.com. You can come trade live with us for 7 days, no cost. So we'd love to have you on board. There is a double your money back guarantee on this program. If you go through all of the 4 hours of training that I'm going to give you, if you take the time to do your one-on-one Zoom call with me to help set up your strategies, and you follow all of the rules that we lay out in our trading room, and you are not just absolutely blown away by your success, your results, and what we offer, I will give you twice your money back. So come in, hang out for a week for free. If you sign up for a month, you get to the end of the month and you're like, this isn't as good as Scott said it was. I'll give you double your subscription back. Okay. So absolutely something that I think everybody should be able to take a look at. If you are interested in our investing program, you can go to tryastforfree.com. That's a great way to get into that program. You've got 2 free weeks there to see how we generate better returns than the market with less overall volatility. If you want to try scalping with us on Tuesdays and Thursdays, we have a live Zoom scalping session. You can go to tryscalpingnow.com. So that gives you guys a good overview of where we're at in the week and what our performance has been. Very happy with our performance. Grateful for all of you guys that are supporting us in our efforts here to build a trading community. Hope you all have a great trading week. We'll see you in the trading room here shortly.